Hey friends, welcome back. I'm Iggy, the Investing Iguana. Thanks to all of you, the channel now boasts more than 1 million reads and over 500,000 watch hours. Tiger Brokers still pegs us at number 8 in its list of 24 influential tigers, and we're just getting started. Today we're tackling Overseas Chinese Banking Corporation's first quarter 2025 results. Stick around while we break down every slide and decide what it all means for your CPF, SRS, or plain vanilla brokerage account. Before we dig into the deck, here's the quick headline. OCBC earned 1.88 billion Singapore dollars, up 12% on the previous quarter, but 5% below last year's bumper first quarter. Net interest margin compressed to 2.04%, an 11 basis point slip from the fourth quarter as the global rate cycle turned south. Yet fee, trading, and insurance income jumped 36% quarter on quarter, cushioning the blow. All right, slide by slide. The agenda page is simple. Financial highlights first, group trends second. Nothing flashy, but it tells us OCBC wants us to see both the snapshot and the moving picture. Slide 3 shows the performance highlights. Total income climbed to $3.66 billion, up 7% from the December quarter. Net interest income fell 4% because loan yields tightened faster than deposit costs, but non-interest income more than made up for it with wealth management, trading, and insurance growth. Credit costs rose to 24 basis points, largely from prudent general allowances, yet the non-performing loan ratio held at a low 0.9%. For Singaporean investors, that low NPL figure matters. It hints at steady dividends even if rates fall further. The next slide splits profit between banking operations and the insurance arm Great Eastern Holdings. Core banking profit was flat versus last quarter. Great Eastern swung sharply higher after an ugly medical claims hit in the fourth quarter. If you buy OCBC for stable banking income, remember to strip out that occasionally volatile insurance piece when you build your model. Slide 5 drills deeper. Customer loans reached $322 billion, deposits $403 billion, and the loan-to-deposit ratio dipped below 80%. In English, funding remains cheap, and there's plenty of balance sheet room to lend when sentiment improves. Non-performing assets edged up slightly but remain tiny versus the loan book. Slide 6 maps earnings by business line and geography. Almost half of operating profit comes from global wholesale banking. Consumer and private banking deliver a quarter, insurance about a fifth, and markets 10%. Geographically, Singapore still supplies 53% of profit, but Greater China provides 21%, a useful diversifier for investors worried about a purely domestic play. Balance sheet strength on slide 7 is hard to ignore. The Common Equity Tier 1 ratio sits at 17.6% under transitional Basel rules and 15.5% on a fully phased basis, top of the class among local peers. The liquidity coverage ratio is a healthy 114%, and leverage remains low. Slides 9 through 13 show the income dynamics. Net interest income fell as NIM shrank, but average interest-earning assets grew 3%, proving that OCBC kept lending even as margins tightened. Then the cavalry arrived. Fee income hit a 5-quarter high of $546 million, driven by wealth management and loan-related deals. Trading income vaulted to $396 million thanks to client flow and hedging demand. Expenses, which had ballooned in the holiday quarter, normalized. The cost-to-income ratio fell to 38.7%. That efficiency drop matters because a bank can't control rates, but it can manage costs. Asset quality slides show stability. New non-performing assets were modest, and coverage rose to 162%. OCBC keeps more than $1.60 of provisions for every dollar of bad loans. As a shareholder, that's the sort of belt and suspenders approach you want during an uncertain macro cycle. Slide 17 details the loan book. Mortgages still dominate at 31%. Construction sits at 21%, finance companies 9%, and transport 9%. Geography-wise, Singapore loans are 42%, Greater China 23%, Malaysia 8%, Indonesia 6%, and the rest spread globally. The mix explains why OCBC weathered the tariff headwinds better than peers with heavier North American exposure. Deposits on slide 18 climbed 3% in the quarter. The CASA ratio, cheap, sticky funding, ticked up to 48.9%. So even if rates fall, OCBC's deposit base remains attractive. Capital on slide 19 circles back to the CET1 ratio. After paying both the ordinary and special 2024 dividends in early May, the ratio still stays near 16%, leaving ample room for growth or more payouts down the road. Let's pause for context. Here's how OCBC now stacks up against its two local rivals. DBS booked $2.9 billion of net profit, with a group NIM of about 2.12%. UOB posted $1.5 billion, and its NIM settled around 2%. Non-performing loan ratios are 1.1% for DBS and 1.6% for UOB. CET1 ratios sit at 17.4 for DBS and 15.5 for UOB. Cost to income runs 37% at DBS and 42.6 at UOB. OCBC holds its own on margins, leads on credit quality, and beats UOB on efficiency, though DBS still edges everyone on absolute profit. For those craving the granular worksheet, every single line item, peer multiple, and valuation toggle, check our Substack. The premium post is already live with the full Excel model and a Monte Carlo valuation spread. Link in the description. So, what's my verdict? Right now, OCBC is a hold that becomes a buy whenever the share price dips below $11. The conservative loan book, Fortress Capital, and fast-growing fee engine balance out the near-term NIM pressure. Major risks are prolonged margin compression, regulatory tweaks to insurance capital, and any unexpected spike in Greater China credit stress. But with a CET1 ratio this high and non-performing loans this low, OCBC has breathing room most banks would envy. We've covered a lot. Net takeaway, OCBC is steady, well-provisioned, and diverse enough to ride the rate cycle. Whether you're building a CPF life-ready dividend portfolio or hunting shorter-term trading swings, keep an eye on the stock when market jitters push it back toward that $11 mark. So we've dissected OCBC Bank's first quarter 2025 report, and I've given you my personal take on what it means for your investments. If you found this deep dive useful and want to level up your investing game, hit the like button, share the video, and subscribe so you never miss an Iguana insight. And for those who want to be truly ahead, our premium members get early access to every video, often a full week before anyone else sees them. That means you receive my detailed analyses and urgent market pointers straight to your inbox well before the crowd. It costs just $1 a month, less than a copy from your neighborhood hawker. Treat it as your daily dose of financial fuel. Ready to join the inner circle? Click the link in the description and become a premium member today. When you're done here, jump over to our latest breakdown of DBS's record fee income. It's the perfect companion piece to today's OCBC analysis. Until next time, remember, stay curious, stay invested, and keep growing your financial future with the Investing Iguana.